Sorry, no. All right, welcome back, everyone, to another Psychology Thursday with Lux, where we're going to talk about the psychology of trading with understanding how we get good entries, understanding liquidity sweeps, and other market manipulations that will occur as a trader. All right, let's get into it. So first, we're going to talk about the psychology behind a good entry while trading. Okay, so point one is understanding what a good entry is. What is a good entry? So a good entry is not just about timing the market perfectly. It's also about having your strong edge. All right, good entries rely on confidence, preparation, and a solid strategy execution. You have to be able to execute something. Even if you have the strategy laid out, you have to execute that well with a good edge. So here are some psychological factors. Fear and greed. We're going to talk about fear first, and it's FOMO. The biggest thing. I've experienced FOMO so much, and I bet you guys have too. FOMO is going to lead to you trading prematurely. So what you want to do is stick to your strategy and trust your analysis. When you stick to your strategy and trust your analysis, that ensures that you're following the rules and that the trade is overall better. And then second of all, greed. It can make you hold on to a trade for way too long or take too excessive of risks. If you're holding a trade for a $5 amount, the chances that that trade is going to go in your way is very unlikely. So yeah, use stop loss orders and set realistic profits and realistic goals with yourself as a trader. Next, we're going to talk about patience and impulsiveness. Great entries almost always come when you're being patient, waiting for the right setup, rather than trying to force some trade to happen. You're waiting for your criteria, your trade to happen. And then impulsiveness also comes from wanting those immediate rewards. So if you're being impulsive as a trader, I'd ask the question that you have the problem. You want those immediate gains. You just want a quick win, something easy, rather than waiting for a whole hour watching the market until something pops up. Okay, now I'm going to have Emmanuel talk about the role of patience in trading.
So what is patience in trading? Patience in trading is going to be, you having the discipline and having, the patience to wait for the market to give you the confirmation you need to hop in a comfortable trade so that you don't have to stress out or get in something sketchy later or, too immaturely and end up losing money. So, for example, letting price action unfold, watching how the market is moving, looking at the volatility, seeing if it's, going stronger in one direction or in the other before hopping into a trade is essential. Like, why would you hop into a trade if you don't even know how the market's feeling that day, This is what patience trading is. So, like, for example, me and Sam in the mornings, we try to wait, 10 to 15 minutes before we hop in a trade. Why? That gives us time to see what's going on. It gives us time to see how the market is moving, what direction it's moving in, and be able to process that and then act from that. You know what I'm saying? So what are psychological benefits from it? Well, trading with patience allows greater objectivity and clear decision making. Basically, what I was saying, you see it, it's more clear to you. You have the confirmation, you feel comfortable doing it, and it just makes you perform better. And it also makes it so that you don't trade markets or time frames where you don't even know what the hell's going on, or you don't even understand what the hell's going on. Because a lot of the times that could be something that happens in the market is, you're trading, but you don't even know what's going on, and you hop in something just because you're kind of like gambling at that point, and you end up losing money. So an example of patience entry would be like price pulling back to a key level, like a support or resistance, with confirmation, and then you enter when the setup confirms. So, like, for example, say the market was going down, it's been going down really strong, and then I see a small buy up. It bounces off like a slight support. I know it's gonna break it, but it bounced off. So I'm probably gonna hop in there because I know that this keep pushing strong. That's it was a good entry, and I waited and I watched and I waited for my personal confirmation. And then impatient entry would be, entering a trade too early without proper confirmation, and just basically losing your money over something stupid. But
Exactly.
back
Yep.
to them.
All right. Guys, next we want to talk about liquidity sweeps and market manipulation. We've seen this a lot in the past week when it gets very, very volatile and when there's big news events like Trump's tariffs and whatever. this is something that you'll see a lot. Big liquidity sweeps and a lot of market manipulation. They want it to look like the market's buying up, even though it's a shit show. Okay, so what is a liquidity sweep? Very basic. A liquidity sweep is when large market players, institutions, hedge funds, etc., push the market price to trigger other people's stop losses. And what I mean by other people is like normal retail traders like you and me trigger those stop losses because they get liquidity. I'm actually going to go a little bit more depth into this right now. So essentially, what I mean by grabbing liquidity is when they get that liquidity, what they're trying to do is have enough orders to enter a trade. So every time you buy and sell, someone wins and someone loses. You're trading, that hence the name trading. So when you sell a put, you're trading with someone who's buying a put, okay? And essentially that's the same thing that they're doing. You can't just always be buying puts because there's a limited amount. So what they want to do, if they see puts, they're going to pump the price up so everyone starts to sell their puts. And then when everyone starts to sell their puts, they're going to buy all those puts. At that point, when they've bought all of those puts, is when the market will come down, and now they have grabbed their shares of what they need by kicking you out of it. All right? So that's what a liquidity sweep is. I hope that makes sense. If you have more questions, always ask us. As always, this occurs when price moves quickly through certain levels, support and resistance, triggering a cascade of stop orders for all these retail traders. And then right after, price just keeps going what you thought it was going to do. And a lot of people get scared out because they see, oh, it's a huge candle. This must be a reversal or something like that. In reality, it's not. It's just simply liquidity sweep. All right, another thing is stop hunts. Market movers will push prices past certain levels to trigger stop losses, creating false breakouts. They will make it look like it's a breakout, and in reality, it's not a breakout. They just want it to go the different way, and they want you to think it's breaking out so they can get liquidity. Same thing. Whipsawing is the market quickly moving in one direction and then reversing, trapping traders. Also, pump dump. Pump and dump is a big one that we've seen today and often. Large institutions might manipulate the price to create a false rally, only to dump it once retail traders buy in. Rug pulling, that too. So that's all about market manipulation. Keep in mind, this is entry level to market manipulation and understanding liquidity sweeps as well as market manipulation. However, if you stay with us, our next classes will start to get more and more in depth. All right, Emmanuel's going to talk to you guys about psychological impact of these liquidity sweeps.
All right. So emotions during the sweeps. A lot of the times we have fear and panic and greed. You know, people see these sweeps. A lot of them get FOMO. For example, when the sweep moves upwards, you know, bulls might be like, oh, you know, we're going back up. And, you know, they'll buy in, they'll get caught in the sweep that wasn't even meant for them to begin with. And, you know, they lose money. There's people who, on the opposite side, do the same thing. So, like, you know, traders may get caught in a liquidity sweep, and they're like, oh, shit, you know, I didn't know. You know, they just how in that example, the bulls think that it's going up because the sweep went upwards. Any bears, any people who were in puts will see that and also think the same thing. So they think that it's also going to go up. So they sell and they lose their money, and the money just goes back to the market. That's a liquidity sweep. And that same money is used to pay off the market when it goes right back down, which they would have profited with if they had just held. Frustration is another big one because, you know, when you get liquidity sweeps, like liquidity sweep is honestly the worst thing that can happen to you in the market. Like, it just hurts, and especially getting caught in it because it just makes you feel like it makes you feel like you want to sue, you know, you want to sue whatever brokerage you're trading with because it's like, bro, like this is fucked, like this isn't even, but it just sucks, and nobody wants to get caught in a liquidity sweep. It's embarrassing, and it just makes you feel pretty stupid. But, you know, how would you manage these emotions? Well, first of all, detachment. So, like, remove your emotions from your trades. That doesn't mean don't care about your money. That just means that when you're looking at the market and you see your trade get swept and you know, you're starting to really think, get worried and stuff, take a few seconds. Watch the market. First of all, if you're getting swept and your stop loss didn't close, then you probably knew what direction you were going in. So let's say your stop loss, you didn't have a stop loss, you're getting swept. Me personally, if you feel confident enough and you can tell to liquidity sweep because it's just abnormal movement, just hold it through. A reasonable trader, a rational trader will probably cut their losses.
Yep.
But if you're being reasonable, being rational and reasonable are two different things. If you're being reasonable, know what you're doing. Look at the market. If you really think it's a sweep, I would wait it out. A lot of the times we get these sweeps, and a lot of the times it doesn't even last that long. It lasts maybe 1 to 2 minute, 1 to up to 5 2-minute candles.
Exactly.
And then stick to a strategy. Having a solid risk management plan. Basically, kind of what I was saying. Like, if you had your stop loss, it doesn't even matter. If you get swept, you get swept. But if let's say you get a stop loss, you get swept, you lose your money, it happens. That's the whole point. But now you have a higher entry point. You got to think ahead. You can't be stuck in what already happened. You got to start thinking ahead. You know what I'm saying? What's the opportunity now? Is it going to start dropping even from a higher point? Maybe you can make up whatever you lost. You know what I mean?
Yep.
But don't get caught up in the emotions of the liquidity sweep and how you lost your money.
Exactly.
But, all right,
and I'm gonna go ahead. Yeah, I'm gonna go ahead and add on to what Emmanuel said too. Another thing you can do with liquidity sweeps is you can understand where they will be, and after a liquidity sweep has happened, you can say, okay, maybe I should hop in now because this is where the institutions want it to go, and where the institutions want it to go is almost always where it ends up going. So essentially, instead of fighting the institutions, we just trade with the institutions because they are truly stronger than the average retail trader. No matter how smart you think you are, the institution is bigger. They have way more people working for them with numerous degrees and all these quicker computers. They're quicker than your fingers, okay? I'll just say that. So that's another thing we look to do at Lux. All right. Next, I'm going to talk about developing the right psychological mindset in order to handle liquidity sweeps. So Emmanuel already talked about this quite a bit, but I'm going to go ahead and talk about some objectivity. So recognize that liquidity sweeps are part of a market structure, and you shouldn't take them personally and not too deep, okay? And emotional control, you got to be able to not chase the market or panic when price spikes in the direction that you don't want it to go. So a good example is I think the other day, there was a strong liquidity sweep, and I got really scared, but Emmanuel saw that as a liquidity sweep, and he didn't panic, and we ended up making a lot of money because he saw through the liquidity sweep. All right, next is adaptability. Be adaptable, okay? Just when a liquidity sweep happens, be ready for it. Don't make impulsive decisions based off of a liquidity sweep. And then strategy and handling, confirmation. Wait for confirmation because after a liquidity sweep, it might not be a liquidity sweep, right? It could be a true move in price. So wait for confirmation to see, is it really a liquidity sweep? And then avoid trading during high volatility. We trade during high volatility, but liquidity sweeps almost always are happening during high volatility moments. All right, so Emmanuel's going to talk to you guys about using market manipulation for your advantage.
All right, so yesterday I saw this Instagram post, and it was like a computer has like the processing of like no. Your mind, like your mind can process something at like 20, something per second. But your subconscious can process the same exact thing at 200 something per second. Now back to what Sam was saying about faster computers, the people who manipulate the market, the big companies having faster computers, way more people, and way more, just resources in general. Trying to fight against them, trying to bet against them is like trying to face off to like a fucking bear and thinking you're gonna win just because you think you can outsmart the bear and probably hit him in the liver and get a good one on him. Like, it's not gonna work like that. You're gonna get sweet. Like, you're gonna get a southpaw to the face and you're gonna get knocked out in 8. You know what I'm saying? So what do I mean by that first thing? The thing about your subconscious. If you use the market manipulation to your advantage, your subconscious will start to record these manipulations. You'll start to be able to tell when they're going to happen. Now, this is usually how I trade. I've been rugged and I've been swept and I've been used as liquidity so many times that I've been able to tell and realize this is about to be a sweep. Oh, this is about to be this. You can tell. When you can tell, you can use that to your advantage by basically, playing with it. Don't fight the market, play with the market. So, a lot of the times people say like, all right, um, day traders are pretty ignorant. They don't really care what's going on in the market. They're just there to make a quick buck off wherever the market moves. Yes, we are here to make a quick buck. And no, we don't care about the tariffs. We don't care about who's at war. We care about making our money daily. At least me. I don't know about you. If you do care, that's perfect for you. I'm just saying, as a day trader, you're not really in that type of game. You're in the game of making sense of what's going on and taking advantage of it. So, like, how do you spot market manipulation? Watch for large movements with low volume. Earlier today, well, actually, it'd be hard to show, but we had this. The market was dropping, and then we had a $2 buy up in less than 5 seconds. It was insane, and it sold right back off. That was market manipulation. It was meant to stop off a whole bunch of people, and it was meant to trap a whole bunch of bulls. It happens. You got to be able to pay attention to it. Abnormal movement. Understanding price behavior around key levels. When things are supposed to bounce and they don't bounce. When things are supposed to go through something that doesn't go through. There's the pressure is there. The people are selling off crazy, but it won't go down. Or people are trying to buy up crazy, but it won't go up. And you can tell. Again, a lot of this comes with experience. Things like that, market manipulation. Strategies to benefit is, counter-ends trading. So after the liquidity sweep, like Sam was saying, look for signs of reversal. So you see the sweep, you see the entry point. Why not hop in? You could take advantage of that. Use that to your advantage to get yourself the upper hand on that. Fade on the fake moves. If a manipulation event occurs, wait for the price to return to the manipulated range before entry. Listen, that $2 buy up that happens today, it was crazy. It was like 5 seconds. It like shot up. It was headed straight down. SPY was headed straight down after going up for like 2 hours. It started going down, and then it hit like this. I want to say like a trend line, and as soon as it hit the trend line, it bought up $2 in like 3 to 5 seconds. It was insane. Nobody saw it coming. What did I do? I watched that, and I just watched it go all the way back down to normal price range because I was gonna hop in a put. When it went back down to the price range, right before that happened, I bought my put because where was it supposed? If you buy $2 up and you sell the $2 back off in like less than 4 minutes, that market is going down. Like it's just clear as day. And boom, it helped me cash out today and come back from a really big loss. So it's shit like that. But yeah, back to Sam.
All right, perfect. Yeah, I love everything Emmanuel said. At the beginning of what Emmanuel was saying, he mentioned something that I really love, and that is your subconscious learning. So yeah, you just need to experience the market, and then you start to understand things. You start to see things that you didn't see before. So that's very much true. I'm going to go ahead and move on. All right, guys, we are just about to end this. Here are the key takeaways that you should have taken notes on. If you haven't taken notes on, these are the key points that you should be walking away this class with. Is trading psychology is just as important as technical analysis, right? I've said this before and I'll say it again. It truly is 80% psychology, 20% technical. Yes, you need to be able to look at a market and see what's happening, but your psychology will absolutely kill you in critical times. Your psychology is what will make or break an account, is what will blow an account or make you scale an account, okay? Good entries require patience, discipline, and emotional control. And liquidity sweeps and market manipulations are common tactics used by institutions so that they can make money and essentially put you where you're stopped out and not making money. All right, liquidity sweeps and market manipulations are common tactics that they use by recognizing these events and learning how to manage them emotionally. All right, effective risk management and objectively will help you navigate the psychological challenges. So when you have your risk management laid out and you have these rules, your rules will not change based on these challenges, because essentially what they're doing, you guys, you have to realize they're not doing anything on a graph. They're doing things in your mind. They want you to get scared. They want you to say, oh, this is not going the right way. I got to get out. I'm going to sell. That's what they're doing. It's not on the graph. It's in your brain. It's them getting to your emotions so that they can make you a bad trader. All right, final thought stay disciplined, you guys. Avoid emotional trading and always trade with a clear plan. All right. You will be swept out. You will have your stop loss triggered. But yeah, that's what we want to do. And yeah, thank you guys. Any questions? Emmanuel, you got anything?
No, I think that was pretty well said. Just a lot of this just comes with it comes mainly with experience, and there's the one thing about trading is you can watch all the videos you want, you can read all the books you want, but at the end of the day, if you're not actually trading and you're getting bent over by the market day in day out, you're not gonna learn how it works, and that's just the hard reality of it. The stock market is not something that you can pay to win or make shortcuts with. You gotta really go through it to be profitable and do as good as you want to do. And honestly, psychology is all that it is. It's what it comes down to it. And yeah, guys, that's about it. But I hope anybody who's watching this video, like Sam said, took notes, especially from these key takeaways right here. And make sure to really pay attention to these liquidity shifts, because they will really mess you up. They will really mess you up. I almost blew a few bands with the liquidity sweep. I was not happy. All right. But hope you guys have a good rest of your night, and we'll see you later.
All right. Thank you guys. Have a good night.